Okay, welcome back to the Attic Hour Podcast, episode 38. Once again, we are joined by Kaden Bussel, financial advisor. Previously, or last week, I guess, we talked about investing with him. And this week, I think we're going to talk a little bit more about personal finances a little bit. And I'm sure that we'll get back into the investing realm.
It seems to always find its way back. So
that's how it works. Yep. First of all, Kaden, what are some of as a financial advisor, what are some of the largest financial mistakes that you've seen young people make who are around, 20s, early in their careers?
Yeah. I think too, it's interesting. Habits are so crucial, good and bad, right? So what I've seen at Strategents and in the industry and in the role I'm in, you talk with a lot of people. You meet with a lot of people. The hardest part for me to navigate, I thought the numbers would be hard, the money side of it. It's the people, because there's a really good book. I highly encourage you to read it. It's called The Psychology of Money. And
I just read that.
Yeah, it's incredible. It's just like, so I'm currently on the tail end of the CFP, which is the Certified Financial Planner designation.
Oh, cool.
And the first section, there's 7 sections you have to get through. And the first section is pretty much client and human psychology. One of our favorite questions, Jordan Arnold, he's the president of our firm. He's kind of like my mentor in the space. He's really good at pretty much finding the root of why are we doing the things that we're going to do? What is money serving for us? Because our firm, there are a few unique things about it. First of all, we're independent. So we're not forced to put clients in any type of certain products. So those actively managed mutual funds. There are certain types of mutual funds that some of these advisors will use in firms where they're called A-shares. So they charge a commission up front that gets kicked back to the advisor, and they're pretty expensive. But the client's money goes into the advisor's pocket before it even hits the market.
Oh, shoot.
So not a huge fan of that. In my opinion, that's a conflict of interest. So that's why we do the index funds, and I kind of want to stay away from investing for at least 5 minutes. But we are independent, so we can shop anywhere, whatever makes the most sense for the client. We're not required to sell someone's index funds, mutual funds, even insurance. We shop the marketplace. We've started to dip our toes into the annuity space a little bit, which an annuity is pretty much you give an insurance company a certain amount of money. It's not invested in the market. And then in return, it's an insurance product pretty much. They pay you either monthly, annual income from it.
Yeah.
A lot of older clients use this for guaranteed income.
Sure.
So we started to dip our toes in that a little bit. So we're not required to sell anyone's annuity product either, which is super cool. Financial planning software. It's a lot more work. Trading is done in-house at our place too. It's a lot more work, but it's definitely worth it. Clients really enjoy being able to have a shop the marketplace for them. So I went on a tangent there, but anyway, we also, a lot of our advice is going to come from biblical principles. We have found that, it's such this taboo nature of God and money, right? How can they work together? So we really try to speak into 5 different capitals of a client's or a person's life. So obviously you have the financial capital piece, physical capital. How are they doing physically? Based upon, God gave us these bodies as temples, and we want to treat them as such. What is our mental capital looking like? Relational capital. So how are relationships within our families, our community? And then last is the spiritual capital. So how are we doing spiritually? So those are a lot of the advice we give might look different from your Edward Jones's. Now there might be advisors that speak into that, but just from a high level view, that's where we would look a little bit different than your Raymond James or Edward Jones, Northwestern Mutuals, things like that nature, where we have a big foundation of our guidance and our we have the 3 G's. It's called guidance, growth, and generosity. So guidance and biblical principles. Obviously, we want to grow all capitals of our life, and then making sure that we're being generous with our money.
Yeah.
it's at the end of the day, it's all God's, right? And we're called to be stewards of that. So how are we positively impacting our community from a financial standpoint, dedicating our time, things of that nature? So those can be tougher conversations with people, especially back to your original question of what are the mistakes you see people make. 20-year-old's probably not going to love for me to come in and say, hey, well, what would you think about giving a little bit of this away for donation? Or what would you think about not spending this on a new car?
Right.
If you would have told me that at 20, I would have just pretty much said, yeah, screw you.
Yep.
But now, 4 years later, I've realized the importance of just our time and our resources. But like I said, at the end of the day, it's not even ours. So with that being said, we see a lot of people come in, especially young people, and they've taken out loans for cars. I've seen a lot of mower loans, which, there's...
Wow.
Pay cash for cars until you get to a point where leasing a car makes sense. It's just one of those things where... And Dave Ramsey has this philosophy of you shouldn't spend more than 50% of your net salary on a car or a depreciating asset, which I think is a very fair statement.
Yeah, I think that makes sense.
Yeah, but to have car payments at 17%, and I where Dave Ramsey and I differ, I am a fan of credit cards when it's under control. If we're paying them off every month, you've got to build a credit score somehow, right? So just making sure, hey, groceries, gas, things here and there, put on the credit card, but it can be a super slippery slope of that mentality of, I'll just pay it off later.
Sure.
Yeah. And then, we've seen people that have 6 credit cards maxed out, and they're taking out credit card loans to pay off other credit cards. And so that's just, and it can happen like that. So just making sure that we're giving people grace for the decisions they make. Because, for example, 20-year-old, have some coin, take a loan out for a truck. Maybe he or she was raised with their parents always having car loans. It was normal for them. There's a lot of people, maybe in my parents' generation, where it's like, I'm working hard for this money, especially in your manufacturing. You're more rougher crowd companies, a lot of trucking companies.
The blue collar.
Exactly. Like, I'm working hard for this money.
Yep.
Why should I not spend it all? It's mine. Some of those, we manage 80 401k plans across 37 states for companies. And we're sitting down with whoever wants to sit down, from the boardroom to the break room, even if it's the CEO or the janitor. One-on-one meetings with about 401ks. They ask questions. We found that's a really good feeder system for our company. We get the 401k. We start creating these relationships with people. When they retire or leave, they have that relationship made. That's when we get personal clients on the side.
Sure.
We also we're able to see other maybe outside assets they have. But there are the contrary. There are a lot of conversations where it's really hard to make someone 3 times my age see, hey, not spending everything and investing it is a good thing.
It's hard to teach an old dog new tricks.
Exactly, and you don't know what their experiences have been. Some of these people started investing in 2007, and then they lost it all in 2008. One of my favorite quotes is, behavioral finance will trump economic rationalism any day of the week. You can show people, what that means is you can show people numbers on a spreadsheet or on a screen. They're the right numbers. This is what you need to be doing. Yep. Wave your finger. But how they feel about it, their experience with it, how they process it, how it makes sense to them, how they see it, that's always going to rule what the economic rationalism of what they should be doing.
Yeah.
So just making sure those habits of saving at least 15% of your gross income every month, to paying yourself first, of putting it into something. And the more you do, the less you might have to work someday, or the more you can give, or the more freedom you'll have. But yeah, getting the car loans, the truck loans. One of my least favorite ones is, the commercial banker, or the retail banker said that I can afford this house.
Oh boy.
Yeah, you know how those conversations. They said I can make it work. Well, just because you can make it work doesn't mean, or you qualify for the loan, doesn't mean you can afford it.
Right.
Yeah.
Because that goes to the, hey, should you rent or buy toss up. It's really tough. It just comes down to opportunity cost. For me, I loved renting. So hands off. Very inexpensive. You just have one thing to pay, or maybe two with utilities. If something breaks, you just got a phone call. It's not your problem.
Yeah.
People, that is some of, I would say I was on the notion previously that, you always have to buy. Always buy. I would say over the last few years, my notion or my stance on that has changed, especially with renting a few years ago, mainly because it is just flat out expensive to just purchase a home. And there's so many sunk costs that go into it that you can't get back. Interest on the mortgage interest. If you don't put down 20% on the home, you're paying PMI, private mortgage insurance.
Yep.
Which is a scam. So you've got that if you don't have the 20% down. You've got maintenance costs, which is at least probably 3% of the home value. People think it's less than 1. It's really not. I think that's the one that most people underestimate.
Really? I didn't realize it's that much.
So for example, Hannah and I, we found our house on Facebook Marketplace. We weren't looking to buy. We were actually looking to rent. But it just worked out to where we found one, and it just ended up working out. Well, this past spring, we've had those crazy windstorms.
Oh.
So roof was 7 years old, needed a new roof. Blew all the shingles off of it in a hole. Roof started to leak into our ceilings, blew out my fence, and then pretty much took my shed to the ground.
Man.
So it's like insurance will only cover a certain, and it's a headache. And in the midst of redoing all that and fixing all that up, our 6-year-old water heater goes out. So it's just like those things that we never really truly account for, those costs, and then the intangible cost of the time it takes to fix things up, to remodel. And usually when you fix something, you don't just fix it back to where it was. You usually spend a little bit more money to get it better.
Yep.
Those things, utilities, there's just a lot that goes into it. So that's probably the number one question I'm asked at work is, hey, I've got this extra cash flow coming in. Should I invest it, or should I pay off my mortgage faster?
Yeah.
And it's my least favorite answer to give, but it just depends. Some people can't sleep at night having debt.
Yeah.
Some people, they can be leveraged to the gill and not blink an eye. It really depends on the person. It depends on the interest rate, too, of the mortgage. I would say if you're looking to pay a home off in less than 5 years, do that. You're probably not going to outpace your mortgage interest rate if it's above 5 to 7% in a brokerage account, if you'd be investing and then pay it off. But there is also where you could do a hybrid where you invest every month, it grows, and there's an intersection where the account grows to the amount that's going to be left on your mortgage, and then you pay it off in one sweep.
Oh.
So there is that too. But that requires more discipline, for sure, and a market that cooperates, and sometimes you can't get either.
Yeah.
Yeah, I would say one of my favorite podcasters, the way he breaks it down is, okay, so you've got about 1% to 2% in maintenance costs. Insurance is huge. Home insurance, that's escrowed, and then property taxes.
Property taxes are ridiculous.
Tripled, right?
Yeah.
And that's escrowed. So that's another expense you don't have when you're renting.
Yeah. I mean, your property taxes go up when your home value, when they say it goes up. It's
yeah,
not
it's assessed. Yeah. It's a mess.
Yeah.
So you've got all that. So you've got about 1% to 2% in insurance. You've got about 1% to 2%. Let's just say 2% in insurance, 2% in property taxes, and 1% in annual maintenance. That's 5%. If you divide that by the home value, or multiply that by the home value, and then divide that by 12, that should give you a dollar amount. So like for $300,000 home, multiply that by 5%, and then divide that by 12. That's like $1,250 a month.
Yep.
If you can't find a place to rent cheaper than that, then it makes sense to go out and try to find and finance a mortgage that's your mortgage. If you can find something to rent cheaper than that you like, that's probably where renting might make more sense for a while. And it just depends on family needs too. As you continue to grow your family and it gets bigger, you might need a bigger space.
Yeah.
So it's harder to find, I don't want to say it's harder to find nicer places to rent around here, but it's more of like your more expensive high-end places in Fort Wayne, Indianapolis, things of that nature. So
Yeah.
thankfully the housing market, it's still ridiculously high here, but it's
cooling off a little bit.
you can make it work.
Yeah.
Yeah, if you need to buy a house, shout out to my bro Jason Johnlows, Holderman Real Estate. He's a good agent. If you ever,
Okay.
All right, I'll keep that in mind.
Yeah.
Yeah.
I had never heard of that concept of the 5% and then like compare that with like renting costs.
yeah, it's just like a tangible number that people can put on paper to see.
Yeah.
Yeah.
Because
Makes
there's so
sense.
many intangible things that go into it. It just kind of helps get a number out there.
I am curious. You said that you like credit cards and like you agree with them. Why do people need a credit score,
Yeah.
and why are credit cards a good thing if you can pay them off?
Yeah, it's a great question.
Wait, hold on. Just to jump on top of that,
Yeah.
because I know my dad is a big Dave Ramsey fan, and
Okay.
so like I
Yeah.
grew up on that stuff.
So are my parents.
Yeah. Which a lot of it is great. Like I completely agree with the depreciating assets.
Yeah.
Like
Yep.
it doesn't make sense to be have a loan on a car
Mhm.
at all. But yeah, with a credit score, like to get a house, people say you need a credit score. However, it is possible to like get have a manual underwriting done.
Okay. Yeah.
But this is like what Dave Ramsey like would recommend. He
Yeah.
uses like Churchill Mortgage or something.
Okay.
Have you heard about that at all?
I don't have a lot of experience in the manual underwriting. I think his philosophy on down payments on homes, because before his understanding is, hey, cash for college, cash for cars, cash for house.
Right.
Cash for cars is the only thing that's really tangible in this market that we're in.
Yeah.
I mean, college, if you go to PFW, you can definitely make it work. Not cheap,
Yeah.
right?
No.
But cash for house, like, come on. Well, I mean,
That's just not practical.
especially if you're wanting to start out younger, it's not going to happen. So yeah, I don't know. In full honesty, I don't know much about manual underwritings. Him and I are in agreement on. I think it's a bad idea to pay down points because it's super expensive and it pretty much does nothing to your insurance rate. But yeah, I don't know enough on the manual underwriting topic. So is that like where you wouldn't have to go through like a mortgage broker or like a bank to
Right,
get
so
underwriting done?
The bank that he recommends. Actually, I don't know if it's a bank. I don't actually know what kind of company this is, but
He probably owns it.
it's probably it's Churchill Mortgage. There's
Okay.
actually one in Decatur.
Oh, no, okay. I
Yeah,
didn't know
no,
that.
but you can go to them and then you basically like sit down and have a conversation with them. You lay out all the like your financial, just all your
Records.
accounts, and you have to have like 2 credit lines that they need to like see proof of,
Okay.
and basically they'll manually go through your financial information
Mhm.
and see if it makes sense to to give you a loan with.
So it's more third party underwriting instead of.
It's not based off of a credit score. Yeah, it's third party.
Okay.
Yeah.
I wonder if Angie Top would be in that realm.
I have no idea.
I think she's at is it Stockton Mortgage, because when Hayden and I were buying that first duplex, we actually, and I don't know if this is too personal information to share, but we actually got rejected from the bank that we went to because we both had good credit scores. He actually had a credit card open since he was 18. Just paid gas and stuff on it, which I think is great. And to your question, Brett, you have to have pretty much a credit score to have those options for loans.
Yeah.
And the quicker you can start building that, the hardest way to get it to grow fast is usually the length of credit.
Mhm.
You can pay all of it on time. A key thing too is to make sure that you don't have more than 30% of your credit limit actively carried on that card. So you don't want to spend more than 30% of that credit card balance. I mean, you can, but your score really accelerates if you keep that amount spent on it 30% of the total available limit to you.
Yeah.
So even if you have 15 grand in the limit, probably should spend less than that.
Yeah.
So, but yeah, then we went to Angie and she wrote it. But yeah, we didn't have, we had 2 years of income, of pay stubs, right? But they were internships.
Sure.
So, I mean, at the time I was really mad that we got rejected. But looking back, I probably wouldn't have taken on the loan either. We didn't have a lot of proof that we could. I mean, we had, we had the funds necessary for it, but from a liability standpoint, I get it.
Yeah.
Mhm.
It was a
So,
risky investment.
Yeah,
For
but
them.
credit cards are great. I mean, I don't really necessarily agree with the argument of points and you can. I mean,
Yeah.
if you spend enough,
You
You get
spend a
points.
ridiculous amount of money, though. to
Yeah,
get-
and I've used points before. I think they're great, but that's not the main reason. There are some great traveling ones. Chase has some really good Chase Unlimited credit cards for traveling, but you've got to be either on the go a lot or flying a lot for it to really make sense.
Okay.
Mhm.
So, but even just a basic, like Discover has a great credit card for students where you get 5% cash back on things. I used
Yeah.
that all through college, and then once I got out of college, moved on to, I've got the Chase Freedom Unlimited, and then maybe one other. I think I had two. I've got two open, but one just has subscriptions on it that are automatically paid off. It's like $20 a month. That gets just rotated through that one just to keep it open.
Yeah.
Because your years of open credit is your biggest friend.
Yeah, because that's what I did. As soon as I turned 18, opened a Discover.
Exactly.
And so
Exactly.
Just
So-
use it for gas or whatnot.
I use it for everything and just pay it off every month.
I use
Okay.
mine for everything too. Just pay it.
The problem was my credit limit started off at like 1,500.
Yeah.
So like I had to start out using my debit card because I would go over 30% way too often, and
Sure.
my credit score it dropped several times. So then once I kept it down low, then it went up enough. They upped my balance, and then now I can use it for everything.
Makes sense.
Mm-hmm.
So, because that's how it worked for me.
Yep.
Yeah. Cool. So I guess you were already kind of going over Dave Ramsey. I'm kind of curious, like, what are all the points that you disagree with him on? You said, yeah, like debt on houses, which I
Yeah.
think he's walked back on that stance.
I
a
think
little
so
bit.
too. I think he's a great resource for the people starting out or people in extreme cases. Like I said, I was raised on the Dave Ramsey CDs and the book and what is it, Money Matters or something like
yes.
that.
That's right.
Yeah, I would say the main ones are what we've already gone over. I don't really agree with his stance on credit and from that standpoint. Cash for house, even for college. I mean, student loans are insane, especially if you decide to go the private 4-year route. Public's bad enough, but private,
It's ridiculous.
It's crazy.
Yeah, I would say though, it just depends how much of a person has on loans. I mean, I've seen some ridiculous numbers, and then the interest rates on those. I mean, people have mortgage payments without a house that they're paying on these student loans.
Yeah.
And when Biden was in office, there was this hope of this student loan
Yeah.
forgiveness, and it's like, well, if you've got this economy that's printing money like crazy, that we're already increasing this debt, I doubt we're ever gonna see it come through.
I would have been
Which I-
so mad if
Exactly,
Yeah.
right? That's one of the main reasons you go to a PFW, right? Is because, hey, I don't want to start out behind the 8 ball in
Right.
terms of a financial situation. Why should we reward someone that went to a large public college that studied art history or theater that racked up 200 grand in student loans, and they can't find a job, or their job pays them $15 an hour?
Yep.
Like, there's
that was my exact thought process.
yeah, I don't want to like trash on useless degrees.
They are kind of useless.
Well, if there's no economic value or benefit, I'm not gonna. If I'm paying additional dollars to pay that student, no, that's not happening.
yeah.
Right.
Now, like information systems, accounting, mechanical engineering, technical engineering,
Electrical.
engineering, and like even my brother, he went to IU, not cheap, but he got his degree in informatics systems, and computer coding, and it's one of those things where you got a good job out of high school, and it's one of those trade-offs where,
Yeah.
hey, if I wouldn't advise taking out a ton of debt, especially that freshman year is where they get you those meal plans.
Oh, that's ridiculous.
Right.
But if it is a degree that it's a highly coveted workforce, or it's going to be around for a while and it pays good, I can see the argument to it. Do I necessarily encourage it? No. I think there are alternatives you can take.
If you're able to pay it off, like, it's a good idea.
Yeah,
So
if you're
probably-
going to be serious over the next 4 years and attack it aggressively and be smart about everything else, yeah, I mean, go for it. But for me, I don't mind having debt when it's, I mean, there's no such really good thing as good debt, but high interest debt, that's bad debt in my opinion. So I'm not gonna do that. I'm not
Yeah.
gonna have that. So
I agree on that. What are your thoughts on like investing on like commodities like gold, silver, copper?
yeah, that's been a hot topic the last couple of years.
Definitely has been.
Just the alternative space. our firm has recently partnered up with some really cool, even Christian private equity firms. Before, I would say the last few years, the private equity space was, hey, you had to have $1 million or a minimum net worth amount. You had to be an accredited or qualified investor.
Yeah.
Where you're either worth outside of your primary residence like $2.1 million, or you consistently make 250 grand a year for the last 3 years. And you can show that, things of that nature. Then you get access to this private equity realm where the private markets are actually like probably closer to 7 to 8. I don't know the exact number, 7 to 8 times the size of the public market. It's like your private companies that are family owned, that these PE firms come in with a ton of cash and buy them out. And so they operate like before. You had to have that barrier to entry was super high because you had to have a lot of money or make a lot of money, and then your money gets invested in it and it's locked up for a minimum of 8 years. It could go to zero. There wasn't a lot of transparency on reporting, on returns. There's just a lot of unknowns about it. But I would say up until recently, now they're starting to roll out what are called interval funds. So they're pretty much mutual funds. They act like mutual funds, but they have private companies within them. And some of them have like a minimum. And those old PE investments, minimum investment was like $1 million.
Oh, my goodness.
Cash.
Wow.
So, like I said, a very niche group of investors, not really available to the retail side.
Right.
So, like these great firms that we use, a lot of them too are Christian owned. Super cool, where they actually have missions of like one company is they'll go in and they build commercial housing for traveling nurses. And then they'll go and they hire a team that comes in and they'll knock on doors and give them a Bible and spread the gospel with them. Or they pay a team solely just to go around and evangelize, because it's just those cool. And then you don't have to sacrifice returns to have kingdom impact, which I think is super cool. But then it's kind of lower this barrier to entry where, hey, instead of some of them do still require you to be an accredited investor, but some of them don't. And minimum investments of $1,000 or $5,000 go into these interval funds, and they produce good dividends, cash dividends every quarter. Solid returns. It actually, you would think that you're taking more risk in a portfolio, but it actually lowers the risk of the portfolio because it's completely separate from the public market.
Oh, people can't just sell on a whim.
Yeah, so there is usually quarterly redemptions with these, where every quarter you're able to either liquidate or buy in. There is a lot more, I would say, from a firm perspective, a lot more compliance that goes into it, rightfully so.
Sure.
But that's kind of the alternative space we've gotten into for our higher net worth clients, and they show up on Schwab. You can trade them on Schwab. You can see returns that feed into our system.
That's interesting.
And they've done pretty well. And just diversifies away from especially AI. Another cool thing that we have at our firm is values-based investing, which what it is we partnered up with a Christian investment fund or company that they'll pretty much go in and they'll take the S&P 500 and they built a screener.
Okay.
And it'll take all the investments or the companies in the S&P 500, and they've got this pretty much this massive, super detailed rubric of, hey, if a company sends donation dollars to LGBT parades or communities, they're out. If they have, like, for example, the ones they screen out, it's hilarious. All the Mag 7s are screened out.
Yeah.
Amazon gone. Apple gone. Amazon sells Plan B abortionate pills on their website. Nope. Out. Apple sends hundreds of millions of dollars to the LGBTQ community. Nope. Out. Doesn't align with our values. Microsoft, Planned Parenthood, things like that. So what then they do was once they screen all of them out, and it's called Inspire Investing.
Okay.
You can look it up, and it's got the screener, so you can type in any publicly traded company on there, and then it'll spit out their Inspire score.
That is very interesting.
So some companies that you think are great, they have a really good research team that goes in and pretty much does an audit trail on where money's going, who's getting what, and then they actually take over what's called the proxy voting. So with proxy voting, as a shareholder, you're able to pretty much have a seat at the table, even though it doesn't really feel like that sometimes, and vote on decisions that the company's making. So they'll pretty much handle all that, and they'll go in and buy up such large portions of companies where they ultimately almost control the proxy voting.
Wow.
And can pretty much swing the pendulum on that. So, yeah, we've partnered up with them, and once I saw their large cap fund, I'm like, this was probably 3-4 years ago. I'm like, there's no way this fund can perform well when it doesn't have any of the Mag 7 in it. And I mean, it's a great diversification away from the AI, the question you asked earlier, the Mag 7, great diversification piece, but there's no way. And I mean, and none of this is financial advice, by the way. I forgot to add that disclaimer at the beginning, but past performance does not dictate future results, but it's outperformed the secular funds over the last couple of years, mainly because the Mag 7 has done poorly.
Sure.
And what they do is then once they get the bad ones out of there, they pretty much go in and find these great, healthy, profitable companies that are ran by good people, and they pretty much add them in this fund. One of their larger positions, one that I invest in individually, the stock position as well, is Old Dominion Freight Line. I don't know if you've heard of them. Their trucks are always going down State Road 1. Great company. It's performed pretty well. They make sure that all their long-distance truckers are home by 6 p.m. every night so that they can have dinner and raise a family as a father.
That's cool.
So, yeah, and they're profitable. Yeah. And they're another company, and there's an AI company. Tim Tebow has something to do with it. He's a side investor, I think. That's a whole other conversation. He's great. But there's an AI company that they pretty much use cameras, and they get pretty much contracted out by the FBI. And it was cool. Last year, they had the FBI came in and said, hey, here's a blurry photograph. Can you tell us where this exact room is in the U.S.? It was blurry picture of drapes and like a comfort on a bed. Within 30 minutes, they had located the room.
What?
The exact room in a motel, and reported it to the FBI. FBI went in, busted in, and it was a sex trafficking ring, and they saved a bunch of kids.
Oh, my goodness.
Wow.
So it's like people using their gifts and talents for good.
Yeah.
So those are the types of companies that are in these funds. So our clients have really, really enjoyed doing that. But yeah, back to alternatives, commodities. Yeah, I mean, gold and silver are a great hedge against inflation. But, I mean, there's been a ton of hype around gold and silver recently.
Well, just like listening to big podcasts like Theo Von, Joe Rogan, like all of a sudden they're all promoting like these companies where you can buy physical gold.
Yeah.
And it just got me thinking. I'm like, I don't know, like if everybody starts doing it, then doesn't that drive the value to, or I guess that, I mean, the demand is so high that I don't think the value's there right now.
Yeah, and I think too, people buy it mainly because it's like a safe investment. You take risks in anything. You even take a risk of not investing your money, right? You're running the risk of losing the value of your cash to inflation.
Yeah.
When inflation's 3.5% and it's sitting in your bank account, you're losing money, and that is a risk.
Yep.
So my opinion on gold and silver is I don't think it's a bad thing to have a 5% of your portfolio in it. Now, we've had people that want to go all in on gold and silver, especially people will see, especially when it was at its peak last year. People see that and, it's I want to buy in. Well, it doesn't make sense to buy into something at its peak.
Right.
And if you think about it, it's up. I mean, it's only up 0.32%.
It like spiked in February, didn't it?
Yeah. So like, as you can see, it's way up now. But if you go back to like 1980, it's actually netted almost a zero gain because it was so high in the 80s. Because especially when Nixon got rid of the gold standard, right?
Oh yeah.
The value of gold was high, and then for 25 or 30, 40 years, it has been pretty much a negative return, and then has spiked recently and returned back to pretty much zero. It's like a U shape.
Yeah.
So people see only this like 5-year return, and it's if you kind of just expand the horizon. But my thing too, and this just goes back to market manipulation. Like you said, buying physical gold, buying gold bars, silver bars. We have some clients that do that. You've got to find a place to store it, and you've got to find a broker that'll pretty much buy and sell, and then the storage fee. So it's super expensive to buy. There's ticket charges that are pretty expensive. There's commissions that are owed, and then you've got to pretty much pay a quarterly fee to have it stored somewhere. And then there's like a ongoing management storage fee on that. So it's just very, very expensive. And then when you go to, how do you sell it, right? You have to find a buyer. So that's what a lot of people are so concerned about buying it, but they don't really think about, okay, what happens when I want to sell it? So that is just my opinion. I don't think having 5 to 10% in gold and silver in a portfolio is a bad thing. I think it's a good diversification piece. But to say, oh, let's just go out and buy gold, I don't think that'd be the best move. So and copper is also in that. I personally have invested in some copper ETFs.
I have that too.
Yeah, exactly. So I think, especially with this whole data center thing, and it goes back to I think, right? I think it's going to be in high demand. It could be a bad investment. It could be good. I don't know. I just do it to see. A lot of them are test runs just to see how they do. Give it a little bit of a runway and then go from there. But yeah, so that's my 2 cents on commodities.
That's interesting. Because my thing is kind of like, I don't know. I've been kind of wondering about like for the last like 6 months, just like I don't have a ton of faith. Obviously, like I'm 20 years old, so like I'm not going to retire for another 40, 45 years, right? So, and honestly, I don't have a lot of faith in the American dollar, like in 40 years. I don't.
That's fair.
But it's so in like my Roth IRA, like does it make sense for me to be buying, like in the American economy, buying ETFs and stock or index funds in the American economy if I don't have faith that it will, I guess, be there whenever I'm 40? And then like what alternatives is there? And so like that's kind of what got me thinking about like gold and silver and such.
Yeah. I mean, at the end of the day, I think that's a good avenue to explore, but with gold, I mean, what's the 5-year return on gold? I know it's a little skewed. Yeah, so I mean it's 124%. Yeah, I don't think it's a bad move, but at the same time too, the way I see those commodities, they pretty much tap out at. I mean, I don't want to guess what they'll return, but I personally have more faith in American companies than a commodity or an inflation hedge against the dollar. I'm with you. I think that the American dollar is not in a good spot. I was talking to a guy yesterday that has a lot of money invested in international currencies, which was super interesting to me. But it's one of those things too where, it's just I don't really have a right. It's not. I don't have a right or wrong answer. Right. It's more just a personal preference. What I know, I'm gonna do and invest in kind of what I know and am familiar with. And in terms of throwing everything into gold and silver at this point currently, I just personally don't think that's just a good move for me. Yeah. Especially when it's at its peak.
Right.
All-time high.
I totally agree with that. It's just like I was like I need some sort of diversification away from the American dollar. So is that cryptocurrency? Is that commodities? Is that international funds? Which from the conversation
international, a little bit of commodities, and I would say just diversifying against sectors too. I'm a huge fan of the industrial and energy sector. Land, and I mean even real estate. I mean I know it's hard, but real estate, if you look, I mean there's 2 different pieces of real estate, right? So you're building equity in this real estate, and it's probably, if you're renting it out, there's some type of cash flow or dividend that comes with it. But if you look at like the historical return of real estate in terms of capital appreciation, it's like 4%. So barely outpacing inflation. That is another thing that needs to be considered when deciding between investing and renting or purchasing a house.
Right.
So, so those things. And crypto, I'm probably the wrong guy to talk to about crypto if you're wanting to hear good things about it. I don't invest in things I don't fully understand. And crypto has always been one of those things where I think Bitcoin and cryptocurrency what Bitcoin did, I think it accomplished what it was. It solved its problem. It solved a problem that they were trying to accomplish with it, which that problem is eliminating a third-party administrator for cryptocurrency or currency transactions.
Sure.
Bitcoin allowed this centralized platform that you could obviously exchange currency.
Yep.
And I think Bitcoin accomplished that, eliminating that third party, and even Ethereum. But to me, I just for a long-term play, I just don't see it as something that is going to be streamlined. There's still a lot of unknowns with it. It's still super expensive to operate. I personally, I have a little bit in like IBIT. It's the exchange, the ETF that tracks the IBIT or the Bitcoin index. I don't invest in crypto. I had a little bit of XRP, mainly out of FOMO, which I have some rules, and one of them is don't get in on FOMO, and it's exactly what I did. And I seriously bought at the peak. Like $3.45 is when I bought, and it went way down. I ended up. And you're never really supposed to sell at the bottom, but I was so mad at myself for doing it, and then mad at just seeing red days that I ended up just getting out of it. But I was kind of hoping that would happen in like a weird sense, to be like, you know what, this is why you don't do that.
To teach yourself a lesson.
Yeah. Exactly. And there are people that think XRP's going to $10 a coin or $20, and for that to happen, I think there's got to be 4 or 5 other massive movements in cryptocurrency and the bigger players like Ethereum and Bitcoin that are going to have to move first. I personally just don't see happening. And then in terms of market share, I don't even see it being possible for XRP. That's my complete personal opinion.
Yeah, looks like XRP's at $1.11 right now.
Yeah.
But at its peak, it was like what, $3.30? Or you already said that, I think.
Yeah. So,
yeah, that's definitely something I regret rebuying just because everybody else was buying it, and it.
Yeah, so I personally don't invest in it. We don't invest our clients' money into it. We have clients that want to hold it, so we'll put it in there for them. But from a portfolio management perspective, we don't really touch crypto.
Yeah, that makes sense. So you typically defer to like what your client wants. Like if your client's very strong or adamant that he wants XRP in his portfolio, you'll do that for him.
Yeah, we'll present the risks that are with it, and usually in those conversations, the client has already made up their mind. And at the end of the day, it's their money. So we can give guidance on it. We can give direction. But at the end of the day, it's their decision.
Yeah, that makes sense.
Yep.
I think one final question is, so like, I mean, working at a financial firm, you obviously interacted with a ton of different people.
Yeah.
I guess what's one thing that you've kind of noticed that like a lot of the successful people or a lot of the wealthy people, what's one thing that they've done differently with their money, or one thing that they do differently?
Yeah. They invest in things, places, people especially, getting the right people around you. A lot of them are business owners. Not all of them, but a majority of them are. Not taking on those bad debts, not leveraging themselves. And the biggest one, which we preach all the time, and I can't believe it's taken me this long to bring it up, but living below your means is the key to everything. I mean, it is just incredible. You see it all the time, and it can be tough, right? That lifestyle creep, that lifestyle inflation. And I know it can be super hard with kids and growing families, and life in general is not cheap.
Keeping up with the Joneses.
Exactly. Materialism in our society are... at our firm, we have an advisor call every Wednesday morning where all the advisors from all location are on it. And we were just kind of going through some data, and there's a negative correlation with economic prosperity in our nation and the overall joy and happiness of our nation.
Interesting.
So our nation is at the peak of prosperity that it's really ever been at, right? And surveys show that we're actually at the bottom of that spectrum of happiness and joy and contentment. And I was doing some more research, and it looked like, based on as far as they could go back, 1920 was whenever we were at a peak data set, you could say.
The roaring 20s.
Of joy, of contentment, of happiness, and patriotism even.
That's interesting.
And it was fresh out of World War I. There was a lot of uncertainties. Wages had been slashed. It it was 1920 itself, and then I know we kind of figured things out later on, but we're at a peak of happiness and not a lot of money, and it's just something that goes to show that like we see people all the time. The more money they make, the more money they spend, and I mean, you pretty much just goes back to you make all this money and work all these hours to spend money to impress people you don't even like, to buy things you don't even want to impress people you don't even like. So it's just going back to, okay, Jordan that I mentioned earlier, he's got this idea of a financial finish line. Hey, this is what we need to live on, and we're not going to really go above that. If we make more than that, we'll give it, we'll invest it, we'll do something else with it. But in terms of, and that could be harder too, especially as we're younger, we're trying to grind, right? You're trying to make it, and you want to start to, no one wants to live a bad life. And I don't think it's this paradox that Jesus calls us to earn all we can, save all we can, and give all we can. And it's like, how do you do that? And it's really just the heart behind it. And we see people all the time trying to keep this inflation or this lifestyle creep, lifestyle inflation up to impress people or to look a certain way or because they deserve it. And that is the number one determinant between the wealthy and the essentially poor. They might be materialistically rich, but they are financially poor.
Interesting. I've seen a study that said or that showed that the people who like give or who give more, they typically like return like like if they give $1 on average, they will gain like it was like $1.03 or something.
It was $1.30, I thought.
But like from the people who would give more would actually make more. It didn't make sense.
I think it's like a mental shift of like,
it has to be.
Hey, I'm not a slave to this money, so I'm just gonna go out and earn it and give it, and I'm just gonna pray for God to give some type of guidance to my life, and I think too, budgeting is crucial. You've got to have a budget. People have no idea what they spend in a month. They know what comes in, they have no idea what goes out, and a lot of them are super shocked to see, more has gone out than what came in.
Ooh.
And that's not sustainable. It can cause strain on marriages. It can cause strains on just relationships in general, mental health, mental awareness,
anxiety.
Especially in men.
Yep.
Because it's hard. I mean, there's this persona that we've got to be providers and we've got to do all these things, and it's like, okay, that is where Dave Ramsey and I would probably differ too. His philosophies are great. Live like no one else, so you can live like no one else. But a lot of his teachings are more, I wouldn't say rooted in self, but like it's so that you can prosper.
Sure.
So that you can have more, so that you can live a life. And it's like, it's not really you, because none of us have ever came up by ourselves, right? It's about our community. It's about the people we do life with. So that's why I say Dave Ramsey and I differ, where it's not just about me. It's not just about you. It's about us.
Yeah.
So, just the wealthy too, that they invest in businesses. They have ownership in something. They are smart with their money. They spend less than they make. And I would just say creating those habits then within their kids. I think it's super crucial too who you marry. Thankfully, I married a good woman. She's a bit of a spendthrift, or was, but she's doing a lot better now. I'm super tight. She likes to spend money, so it's been good for both of us.
Sure.
Who you marry is huge, because even like with Hannah and I, we were both raised in the same community, same church. She's 2 years older than me. Raised completely different around money. No right or wrong way. Just how we were raised around money is just completely different. How we talk about it, how we view it. That's a huge part too. If your spouse isn't on board and not in line with your goals, it can be really hard to get somewhere. So
that's interesting. I think that's a great note to end it on.
Yeah.
Thank you for coming on.
I appreciate you guys having me on. So this was fun.
It was fun. No problem. All right. I hear the outro music coming on.